Hey everybody, it's Justin here, America's Honest Tax Accountant with Number Crunch Nerds. Welcome to part 2 of my 2024 tax filing season video series for small businesses and individuals. In this video, we are doing 2023 tax returns due April 15th, 2024. But as you know, if you're watching my Roth IRA conversion video series, the concepts we are about to go over in this video will apply to your 2023 tax returns, 2024, and 2025. And why is that? Because the Tax Cuts and Jobs Act will most likely remain the law until the end of 2025. Now, with the making of this video, we are right in the heart of tax season. So for the remainder of this video series, we are just going to jump right in. This particular video that you're watching is going to be about taxes on your rental properties, which is Schedule E. Schedule E is part of your Form 1040. I am going to be using TurboTax Home and Business Edition for the remainder of this series, so let's get started. So here is TurboTax right here. Again, I'm in the Home and Business Edition. This is the 2023 edition. I'm on the Business tab right here, Business Income and Expenses. Let's find some business deductions. I'm going to click Continue right here. I am going to choose what I want to work on for this video so we can get to our rental properties. Right here in this second section right here, rental properties and royalties, income and expenses from rentals and other items, we're going to click Update right here. Okay, income from rentals or royal property that you own. We'll cover all these items. Rental property is what we're interested in. Do you want to review rental and royalty? Yes. All right, so far you are not a real estate professional. Real estate professionals may pay less tax since their rentals are considered a business. Will determine if this applies to you. Check the items that apply to you or your spouse in 2023. This return that you're looking at right here is set up for a married filing joint couple. That's why it asks about your spouse right here. If you're filing single, it would just say you. Basically, what this question right here is asking you is, are you a real estate agent in most cases? Now, it's possible you could be a real estate professional and not necessarily be a real estate agent, but in most cases, for most people, you would probably have to be a real estate agent to meet the criteria for this question. Let's go through what it is. I spent more than 750 hours a year actively involved in real estate, sales, management, etc. I have a complete records for this time. I spent more than 50% of my work-related time involved in real estate, or none of the above. Now, again, if you have significant rental activity and you spend a lot of time doing it, you might meet this criteria. And why does this matter? It matters primarily for losses. If you're creating losses or you're generating losses from your rental properties, a real estate professional would be able to take more losses, whereas your average Joe and Jane that are just renting like a second house, or could they have a couple of rental properties, you're not, in most cases, are not going to be considered a real estate professional unless you meet this criteria right here. And so you will have more limits on the amount of losses that you might be able to take against ordinary income. Income from real estate activity is considered passive income or passive loss, unless you're in the business of doing it. That's why if it's considered a business and you're in the business of renting property, then it would be considered active income or ordinary income and not passive income. There's a lot of special rules when it comes to passive activities and passive income, and in particular passive losses. So for your average person, I'm going to click none of the above right here. We don't meet this criteria to be a real estate professional. Continue. Okay, is this a rental property or a royalty? A rental property is real estate that is leased or rented out to others. Royalty property includes a right to income from things like oil, gas, mineral properties, and so forth. So we're going to do a rental property here. I'm going to select this option right here, and let me just put in this information here. All right, so I have an address in there. We don't need to belabor that point. Continue. Okay, what type of rental is this? For this example, I'm going to do a single family unit, and then that's the most common one. And then we'll come back in future parts of the video and we'll do some of these other ones. So for now, single family unit, continue. Okay, now here are some special situations that could apply. Like it's a new rental, you sold it, you rented out like part of the house, you converted it from personal use to rental or rental to personal use or something like that. And then carryovers of like passive activity real estate losses. This is what I was just mentioning a few minutes ago. Passive losses are kind of a thing that needs to be tracked separately when you're dealing with your rental properties. For this example, going forward right now, let's just start with a new property for 2023 and we'll see what applies to that, and then we'll do some of these other ones in a little bit. So let's start with new, continue. All right, was this property rented for all of 2023? Now in this scenario, I said we purchased it in 2023. It was a new rental in 2023. So let's just say no, that in this example, this property was not rented for all of the year. It was only rented part of the year, and let's see what else we get here. So during the period in 2023, this property was a rental. Tell us how many days the property was rented at a fair rental price and how many days it was used for personal reasons. Don't include days when the property was vacant. So what is the key to all this? What is the IRS trying to make sure that you're doing appropriately? Well, fair rental price, the reason that they want you to charge a fair rental price is so that you're not creating losses. Like if you're charging like too low of a rent, which you might, do to like with a family member or something like that, and then you're charging, you have like all these expenses, people, they try to create losses that way, and the IRS doesn't want you to do that. So they want to make sure that you're renting it at a fair rental price and basically a market price. Like if an unrelated person went into the market to rent a house that was like the same size, for the same reasons, same conditions, same furnishings, all that stuff, like are you charging the same rent that they would get if they went on Zillow or somewhere and found an unrelated person and rented from them? And this is something that you it's not like a mystery. Either you are or you're not in most cases. If you're really not sure, you could probably Google, like what common rents would be in your area for units that are similar to yours, and you can determine if you're actually renting it for a fair rental price. If you're not renting it at a fair rental price, you're going to have disallowed losses, assuming that your property is generating losses in the first place. So let's just assume for this example that this is an arm's length transaction. It's not like a related person or a friend. And so let's just say that we rented it for 250 days out of 365. And you'll figure out, however many days applies to you. Let's say that personal use was 0. In this case, personal use is the same kind of concept. Like they don't want you to create losses on property that you're using for personal reasons. So you are allowed to use the property for, I believe it's 14 days. You can use it for personal reasons within a year. Don't quote me on that. You Google that, make sure 14 is the right number. But as long as you're using it for less than 14 days, I believe that it's basically considered a true rental property. If you start using it for more than 14 days, then you may be limited on, assuming that your property is generating losses. If it's generating income, then there's nothing to limit. So this doesn't apply. I did not rent it. In this case, we did rent it for 250 days. Continue. Okay, property ownership. Were Mickey and Minnie, this is my Mickey and Minnie Mouse return here. Were they the only owners of the property in 2023? For this example, I'm going to say yes. And this question is not about, remember I said we purchased the property in 2023 in this example. They're not talking about the previous owners who owned it earlier in 2023. This has to do with partial ownership at the time when you owned it. Let's see what it says here. Partial owner, if you own less than 100% of your rental property, then you're a partial owner. So that would basically be like if you and multiple other parties of some sort, whether it was other individuals or maybe people owning property within a partnership or an S corp or a corporation or something like that. If you are not 100%, or you and your spouse are not 100% owner, then you would click no here. I would, for this example, I'm just going to say yes to make things straightforward. Okay, let's find out if you're an active participant in this property. Now, this is a different question than we saw before. That first question about being a real estate professional, That is a different question than this. That question allows you to treat the rental property as a business, basically. And then so all of your business losses could potentially be allowed. Remember, all these questions have to do with losses. If your rental property is generating income, then the answers to these questions don't really matter. Income is income and it's going to be taxed. Now, in some cases, if it's passive income, you could use suspended passive losses from previous years. We'll get to that later against that. But these questions really are more about losses if your property is generating losses. Now, if you're an active participant, let's see what it says here. The term active participant refers to a special category of rental property owners. Active participants in a rental property may qualify for additional write-offs. Again, like you can take some of your losses, assuming you're generating losses in the first place, if they have a loss on the property. You qualify as an active participant if you can say yes to both of these statements. I own at least 10% of the property, so that's going to be yes for most people. In this example, that's going to be a yes. We said that Mickey and Minnie owned 100%, so that's a yes. I made major management decisions for this property, such as approving tenants and authorizing repairs. So the first one is pretty straightforward. The second one, some people are not sure what to answer here, if this is a yes or a no. And my personal opinion is you go to the think about the broken toilet test. This is not an official IRS guideline or anything like that. It's just my personal opinion and best practice. If the toilet breaks in the rental property in the middle of the night, who is going to get the call? Are you going to get the call? Are you going to be the one who authorizes the repair person to go out there? Or maybe you go out there and fix it yourself. You're the one who deals with getting tenants and signing the lease and collecting rent, and you get that call in the middle of the night. If the answer to that is yes, then you have a pretty good position, in my opinion, to say that you are actively participating. Now, what would be the alternative to that? What would be the opposite? Well, in the most common scenario would be if you have a rental, a management company or a manager of some kind dealing with all of this. If you have a management company taking care of this property, they deal with all the tenants, they collect the rent, they deal with repairs, they're the ones who get that call in the middle of the night if the toilet is broken. You have outsourced all of those management responsibilities to a management company who collects a fee, and all you do is basically collect the net rent after all the expenses, after the management fee, all that. You collect that net rent at the end of the month, then highly likely you're going to check no right here, that you are not actively participating. Okay, so it's kind of a give and take. Like if you're going to outsource all the responsibility for managing the property and all you do, you never see the tenant, you don't deal with anything, then you don't get to take losses of any amount generally. It's all going to be passive. You could take it against other passive income, but it's all going to be passive. If you answer yes to this, if you meet both of these criteria, you're going to end up qualifying for what a lot of people call the poor landlord exception. And that's going to mean that you'll be able to take some losses. Assuming that your property is generating losses in the first place. You'll be able to take some of your passive loss against other kinds of income, like earned income from a job or business income or active income. You'll be able to take some passive income. I believe it's $25,000. We'll check that threshold a little bit later in the video. But you'll be able to take some losses, assuming that you're generating losses at all. There's also a guide here, which I'm not going to go through right now, but this is another thing you can look at if you're still not sure how to answer this question. And I'm going to click continue. I'm going to say yes. So we're going to show a loss. We're going to do an example a little bit later where we have a loss, and you'll be able to take it against other kinds of income. So continue. Okay, did you pay anyone $600 or more for work related to this property? If you did, it is possible that you have to file a form called 1099 NEC. That is a completely different topic. If you're interested in that topic, go check out my channel, Number Crunch Nerds, or just search in YouTube for Number Crunch Nerds and 1099 NEC, and you will find this video right here all about why and how to deal with 1099 NEC. That's a whole different topic. For purposes of this video, this question is simply asking you to mark on your tax return, to mark on your 1040, on your Schedule E, basically. We'll see this later when we look at the form. You have to mark whether you did or not. Basically, did you do this payment and did you file this form, assuming that you were required to? So for most people who are complying with what they're supposed to do, and if you are required to file this form, then you would check this right here. And then it asks you again, did you actually do it, basically? And so assuming that you're following the guidelines, you can go watch that video on the 1099 NEC if you're not sure what that is about, but you are paying someone more than $600. But if you're complying, you would click yes, and you would click yes here as well. Continue. All right, now is the time when we're going to start entering all the income and expense items. So if you're using Quicken or QuickBooks, you can certainly import all of that stuff. For this video, I'm going to enter it myself so you can see how it goes line by line. If you're not using these, you'll be entering it yourself like this. So this is video 2 of this series. I'm going to stop this video right now, and in video 3, we're going to pick up right here and start entering the rental info and expense.